Welcome back to the Commercial Real Estate Report with Chris Berg, brought to you by Abernathy Holdings.
Always great to be here.
You know, we always bring you the most impactful insights to help your commercial real estate businesses thrive.
That's right.
Today, we're diving into this dense report from the New York Fed
Oh, yeah, I saw that.
on the state of commercial real estate.
Big one.
And let me tell you,
Yeah.
what we found
Okay.
is alarming,
Really?
to say the least.
Lay it on me. What's going on?
Okay, so commercial real estate valuations have taken a hit,
Yeah.
especially in the office sector.
Mm-hmm.
This report uses REIT stock performance as a proxy
Okay.
and compared to the broader market,
Right.
like the NYSE Composite Index.
Yeah.
These REITs are down about 40%
40%.
from their peak back in late 2021.
That's massive.
It is.
Wow.
And for those of you who might not be familiar,
Yeah.
REIT stands for Real Estate Investment Trust. They're basically companies that own and operate income-producing real estate.
Uh-huh.
So this drop in REIT stock performance is a big red flag.
I see where you're going with this. We all know the rise of remote work is a huge factor here.
Right. And the report backs that up. It highlights the increase in work-from-home rates,
Yeah,
which are still way above pre-pandemic levels.
for sure.
Even NYC subway ridership,
Yeah.
which is a decent indicator of people going to work,
Oh, interesting.
has taken a hit.
Mm-hmm.
Less people are commuting to the office,
Right.
which means fewer tenants for those big office buildings.
And fewer tenants means lower rental income, which directly impacts property values.
Exactly.
But what's really fascinating here
Yeah.
is how this ties into the broader financial system. This isn't just an isolated problem
Right.
with empty offices.
Exactly. And this is where things get really interesting
Okay.
and potentially scary.
Right.
The Fed's interest rate hikes
Yeah.
have put immense pressure on banks,
Right.
especially those with weaker capitalization.
Mm-hmm.
They've taken some pretty big losses on their securities.
Yeah.
Something called mark-to-market losses.
So for our listeners who aren't immersed in finance,
Okay.
mark-to-market basically means that the value of the assets these banks hold has gone down.
Right.
It's like if you owned a building valued at $10 million,
Okay.
but because interest rates have risen,
Mhm.
similar buildings are now selling for $7 million.
Right.
You've just experienced a mark-to-market loss of $3 million.
Ouch.
Ouch is right.
Yeah.
And it's not just an accounting quirk either.
Right.
These losses make banks look vulnerable to regulators,
Uh-huh.
and even worse,
Yeah.
could scare off depositors.
Right.
Remember what happened back in March
Oh, yeah.
with Silicon Valley Bank?
Right.
We don't want a
See if
repeat
we do
of that.
No, we certainly don't.
And this report shows that this vulnerability has actually gotten worse since late 2020.
Wow.
Let's connect this back to commercial real estate,
Okay.
specifically those distressed CRE loans
Right.
that are weighing on bank balance sheets.
The report defines distressed using the property's net operating income,
NOI.
or NOI.
Right.
Essentially, if the NOI has dropped since the loan was made, that's a big warning sign.
Uh-huh.
It means the property isn't generating enough income
Right.
to cover its debt payments.
For sure.
Think of it like this.
Yeah.
If your building isn't bringing in enough rent to pay the mortgage,
Yeah.
you're in trouble.
Big trouble. And that's where the banks, particularly those with weaker capitalization,
Uh-huh.
are playing a dangerous game.
Whoa.
The report calls it extend and pretend.
Extend and pretend.
Ah,
I like that.
yeah.
What does that mean exactly?
Well, they're basically delaying the inevitable.
Okay.
They're assigning lower probabilities of default to these shaky loans
Mm-hmm.
compared to their better capitalized counterparts.
Right.
And get this, those distressed loans from the undercapitalized banks are actually defaulting less often.
Wait, how is that possible?
It's wild.
Are they cooking the books?
Not necessarily. They're just postponing the problem.
Whoa.
The report reveals that undercapitalized banks are much more likely to extend the maturities on these loans.
Okay.
Instead of facing a default and having to write off the loan,
Yeah.
they're just stretching out the due date,
Uh-huh.
hoping for a miracle.
So they're kicking the can down the road,
Exactly.
hoping things will magically improve.
Hoping against hope.
But we all know that can't go on forever, right?
Nope.
What are the consequences?
Right.
of this extend and pretend strategy.
It's creating a dangerous illusion of stability in the market.
Right.
But the reality is
Yep.
we're sitting on a ticking time bomb.
Oh, boy.
This extend and pretend game has serious consequences.
Like what? Give us a rundown.
Well, for starters, it's starving the market of new credit.
Okay.
Think of it like this. The CRE market needs a constant flow of fresh capital to function properly.
Right.
But this game is essentially cutting off that supply.
Oh, wow.
The report shows that undercapitalized banks are originating fewer new loans,
Huh.
both in commercial real estate and even spilling over into corporate lending.
So that's bad news for anyone looking to develop new projects or refinance existing debt.
Exactly.
Wow.
It's also slowing down necessary adjustments in the market.
Okay.
We need that capital to convert office space to residential or other uses to adapt to the changing demand.
Right.
But without it, we're stuck in limbo.
So we've got this artificial sense of stability,
Uh-huh.
but in reality, the system is becoming more and more fragile.
Yeah, and here's where it gets really interesting
Okay.
and maybe a little scary.
Right.
There's this massive wave of CRE loans coming due in the next few years.
Yeah, I've heard about this.
The report calls it a maturity wall,
Maturity wall.
and it's a huge red flag for anyone in commercial real estate.
It sounds pretty ominous.
That's right. We're not talking about a small ripple here.
What?
This maturity wall is a tsunami of debt coming due.
Oh, wow.
And if those loans start to default
Yeah.
because banks can't keep extending maturities,
Right.
well, the consequences could be catastrophic.
Okay, so walk us through those consequences.
All right.
Paint a picture for our listeners.
Sure.
What happens if this maturity wall crashes down on us?
Imagine a domino effect.
Okay.
First, you have those defaults hitting bank balance sheets hard.
Yeah.
Remember, their capital is already strained from those mark-to-market losses we talked about.
Right. Ouch.
This could be the final straw.
And if banks start failing, what then?
Panic sets in.
Oh, no.
Depositors rush to pull out their money,
Yeah.
potentially triggering bank runs.
Uh-huh.
We've seen this happen before,
Right.
and it's not pretty.
It would be like the 2008 financial crisis all over again.
Exactly.
Only this time it's centered around commercial real estate.
Exactly.
Right.
And as banks struggle to stay afloat,
Yep.
they're going to be desperate to raise cash.
Uh-huh.
What do?
I don't know. What do?
They start selling off their assets,
Right.
including those commercial real estate loans.
Which leads to fire sales.
Exactly.
Prices plummet as banks scramble to unload their CRE holdings.
And that hurts everyone, even those property owners who weren't directly involved with these distressed loans.
Right.
It creates a downward spiral, dragging the entire market down with it.
So what you're saying is even if you've got a solid property with responsible financing,
Yeah.
you could still get caught in the crossfire of this extend and pretend fallout.
That's the scary part.
Yeah.
This isn't just about a few bad apples in the banking sector.
Okay.
It's about a systemic risk that could impact everyone in commercial real estate.
So we're potentially looking at a perfect storm brewing in the commercial real estate market.
Yeah, it's not looking good.
But the big question is, what's the trigger?
Right.
What could set off this chain reaction?
That's the million-dollar question, isn't it?
Yeah.
The report doesn't pinpoint specific triggers,
Okay.
but it certainly paints a picture of a system on the brink.
Hmm.
One possibility is that regulators step in
Uh-huh.
and start scrutinizing those maturity extensions more closely.
Okay.
They could force banks to stop delaying the inevitable,
Right.
which could accelerate the defaults and kick off that domino effect we talked about.
So stricter regulation could actually make things worse in the short term.
It's possible. It's like popping a bubble.
Okay.
It might be painful at first,
Yeah.
but it could prevent a bigger disaster down the line.
Okay, so regulation is one potential trigger.
Right.
What else should we be watching out for?
Keep a close eye on interest rates.
Okay.
If the Fed keeps hiking rates, that pressure on bank capital will only intensify.
Uh-huh.
And those mark-to-market losses on their securities could get even bigger.
Right.
That's fuel on the fire for this whole extend and pretend problem.
What if the Fed pivots and starts lowering rates?
Yeah.
Wouldn't that provide some relief?
It might.
But it's not a guaranteed fix.
Mm-hmm.
Even if rates stabilize, the underlying problem remains.
What's that?
Commercial real estate valuations are out of sync with reality,
Right.
especially in the office sector.
Yeah.
We need to see a fundamental shift in demand to justify the current values, and that's not happening anytime soon.
So it's not just about the financing side of the equation.
Right.
The fundamentals matter too.
Absolutely.
Okay.
And speaking of fundamentals,
Yeah.
keep a close eye on vacancy rates.
Right.
If those start to creep up in other property types like retail or industrial, that could signal broader weakness in the market.
And we can't forget about those ripple effects we talked about earlier.
Right.
A struggling economy, job losses.
Yeah,
Those things can send shockwaves through the commercial real estate market.
exactly. It's all interconnected.
Right.
So where does this leave us?
Yeah, where does this leave us?
What can our listeners do to protect themselves and even thrive in this uncertain environment? Give us the game plan.
All right.
What are some actionable steps our listeners can take right now?
First and foremost, don't bury your head in the sand. The risks outlined in this report are real.
Yeah.
Ignoring them won't make them go away.
Right.
Knowledge is power.
Okay.
The more you understand about these underlying dynamics, the better equipped you'll be to make informed decisions.
So step one, acknowledge the problem.
Right.
What's next?
Take a hard look at your own portfolio.
Okay.
Where are your vulnerabilities?
Hmm.
Do you have a significant amount of debt maturing in the near term?
Uh-huh.
If so, what are your options?
Okay.
Can you refinance at a favorable rate?
Yeah.
Do you need to consider selling some assets to reduce your exposure?
Hmm.
These are tough questions, but you need to ask them.
And don't forget about due diligence.
Oh, that's a good one.
If you're looking to acquire new properties,
Yeah.
now more than ever, it's crucial to thoroughly assess the financial health of the seller
Right.
and the underlying fundamentals of the asset.
Absolutely.
Don't just rely on pre-pandemic valuations.
Yeah.
Things have changed, and you need to adjust your approach accordingly.
Great advice.
Thanks.
It's also important to remember that this isn't just about playing defense.
Okay.
There are still opportunities out there.
Oh, good.
For those who are willing to be strategic and adapt to the changing landscape.
Like what? Give us some examples.
Well, as we've discussed, the office sector is facing some serious headwinds.
Right.
But there might be opportunities in areas like industrial logistics or even specialized properties like data centers.
Interesting.
These sectors are benefiting from trends like e-commerce growth and the increasing demand for data storage.
Interesting. So it's about diversifying and looking beyond the traditional sectors.
Exactly.
What about those who already own commercial real estate?
Yeah.
What can they do to protect themselves?
Review your debt structure. If
Yeah.
you have loans coming, do soon explore refinancing options now while credit is still available.
Right.
And consider stress testing your portfolio.
Stress testing.
What would happen if interest rates rise further?
Ah,
What if vacancy rates increase?
okay.
What if your tenants start defaulting on their leases?
Oh, boy.
Being prepared for different scenarios can help you make better decisions under pressure.
This is all great advice.
Thanks.
And it just goes to show that even in challenging times like these,
Yeah.
there are ways to not just survive, but thrive in commercial real estate.
Absolutely.
It's all about being informed, being strategic, and being proactive.
Absolutely. And remember, we're here to help you navigate these turbulent waters.
That's right.
The Commercial Real Estate Report with Chris Berg will continue to bring you the insights and analysis you need to stay ahead of the curve.
That's right. And a big thank you to our sponsor, Abernathy Holdings, for making this deep dive possible.
And thank you to all our listeners for joining us.
Yes, thank you.
Remember, stay informed, stay engaged, and as always, stay ahead of the curve.
Until next time.